Hey everybody, welcome to a Wednesday morning, make that. It is time for the game plan. I am pumped to be here with you guys today. This is fantastic. We have lots to cover, including macro data this morning, chart setups, Bitcoin action, and everything else. So welcome to the game plan. We're going to get right into it. Today, I'm going to welcome Greg Dickerson. All right, now Greg Dickerson, come on over, buddy. He's here with me today, and I want to introduce him. He is an elite real estate investor. In fact, to the point where we've now shot a course on real estate investing. And I wanted to just welcome you. We're going to talk about the housing data today because I think it's really important to kind of go over what the heck is going on. But welcome to the game plan. You're my first guest.
Yeah. You know, we've been talking for years. We finally got to meet in person down here in sunny Florida. So yeah, man, thanks for having me. I'm excited to be here.
It's wonderful. So we'll talk about your course in a little bit because I think people will want to know a little bit more about it. But just looking over here, guys, check this out. So this morning we got housing. The housing market's big problem isn't what you think, but ultimately housing starts rebounded to 3.9% in July after an 11.7% drop. Builders ramped up construction, so we have some kind of upticking going on in the housing market. It seems like maybe builders, what do you think about this data? I mean, you know, what's going on here? Are builders saying, hey, we know we can make money right now, prices are staying high, so let's build more?
Yeah, so it's very interesting. So even though new starts are up, and some of that can be confusing because multifamily might be mixed in there. So for people that don't know me, I started my career as a builder. I'm a builder developer. I've done hundreds of millions in residential construction, multifamily, commercial, all that. So the time to build is when there's no inventory. Right now, the housing market, there is zero inventory out there in most markets. Real estate's hyper-local. Every market's different. So the time to build is when there's nothing for sale in the resale market. So that's why the builders have been doing so well. They can't get the labor to deliver all the units we need. We can't build our way out of this inventory problem. It would take 10 years. There's over 1 million units short. There's normally about 2 million houses on the market for sale at any given time. There's almost less than 1 million right now. It's a really tough time for the housing market. So builders are excited because they need to build. It's a great time for them. But at the same time, interest rates have shot up to record highs. We haven't seen interest rates at this level in 20 years. Although it's not a bad interest rate, 7.5% if you go back. Is not a bad interest rate, but where we came from, it's terrible.
That's the problem, right? It's like the younger generations are used to these really low interest rates, and to now see the payment on a 30-year mortgage at 7.5%, 8%. I mean, that is shocking. I mean, even for me, and I'm in my 40s now, I can't even imagine going back and trying to get a mortgage payment for that at this point. So, excuse me. So how do younger people deal with this? I mean, prices are still sky high, right? In fact, behind you the Case-Shiller price index, basically we had this tiny little dip, right? Just ever so slight dip, and now we're moving back to all-time highs on housing. So how do younger generations afford to do this?
Great question. So what the builders are doing right now is they're offering what's called buy downs. So they're offering 3-2-1 buy downs. So maybe the interest rate is 7.25% on a $500,000 house. The builder for $40,000 can buy that interest rate down 3%. So your first year, you can get a 4.5%. Your second year, 5.5%. Your third year, it goes to 6.5%. Your fourth year, it resets to 7.5%. I bought my first house in 1990 on a 3-2-1 buy down when interest rates were 9.75%. So the thinking is, as a young individual, your income is going to go up. So you'll be able to afford the payment as it goes up. So that's why builder sentiment is down right now, because it costs them money to do this. It affects their profitability. The really interesting thing about the housing market, the builders are the most efficient sellers in the market. They are way ahead of the curve. So if you want to know where the housing market is going, watch the builders, watch what they're doing. If they're offering incentives, that tells you something. If they're raising prices like we saw in the pandemic, prices were going up, builders were just escalating. It was carte blanche for the builders. That tells you got a red hot housing market. The housing market is cooled right now for 2 reasons. We're doing this right now. It's August. So seasonality. This is typically a slow time for the housing market because everybody's on vacation, things like that. You couple that with record high interest rates, that creates even less demand in the housing market. So builders have lost traffic. Interest rates are high, people are on vacation, they've checked out. The key is, let's see what happens in the fall. Let's see what happens in the Fed next month. Watch the builders. They are the most efficient sellers in the market. They are the best gauge of what the housing market is doing.
So one of the things you're talking about, this buy down of interest rates or whatever. So number one, I've never heard of that, and that's really cool. So anyone out there watching, like, that's freaking, think about that. If you're a first-time home buyer, look into this. And then my question in that regard, the first thing that popped into my mind is, okay, so you're buying down your early interest rate, but eventually it goes up. can you then refinance? Like, let's say eventually we think that the economy weakens, the Fed has to lower interest rates. Can you then refinance?
Yeah, great question. So yes, you can, and that is the danger in the market. We lost our screen. That's the danger in the market right now, is that a lot of people are buying at these record high prices, record high interest rates, assuming rates are going to come down. Now, mortgage interest rates are based on the 10-year bond, the 10-year treasury. So you want to watch the 10-year treasury. 10-year treasury has spiked lately. We can talk about why that's happening. But as the 10-year treasury comes down, like we saw during the pandemic, that's what brings mortgage rates down, because the investors that invest in mortgage-backed securities for residential homes are gauging their risk return based on a 10-year treasury. If they can buy a 10-year treasury at no risk for 5%, why would they want to buy a mortgage that has risks, you know, at 6 or 7%? So watch that 10-year note. But yes, a lot of people are banking on that refinance. The other thing too is, it's not just builders that can offer a buy down, resales. So existing homes, the seller can offer a buy down as well. So you can use this on resales, you can use this on new homes, but do not assume interest rates are going to come down and you're going to be able to refinance at some point in the future. They may come down, they may not come down. We don't know. It's the 10-year treasury, not the Fed, that affects mortgage interest rates.
All right, and last question on this that I have, which is an important one. So yesterday, Neil Kashkari, one of the presidents of the Federal Reserve, one of the bank presidents, he basically said he was shocked that housing has stayed as strong as it has. Why is that the case? Like, why? I mean, first of all, why is a Fed president being shocked at anything? That would be the first question. The second question is, why is that happening?
Yeah, so they just completely missed the boat in housing. So housing is about two things, right? It's about demand, it's about availability of units, it's about the financing. The financing drives the deal, and the availability of the financing and the cost of that financing. So when we went through the pandemic, that kind of created a shock to the housing market. People pulled their houses off the market. Then we moved into this work from home environment. So the Fed didn't see what was going on in the housing market with houses being pulled off the market for the pandemic. They didn't see and anticipate, wait, people aren't going back to the office. They're leaving cities. They're moving to the suburbs. So a lot of the housing units got absorbed by people exiting cities, moving to suburbs, moving to resort areas. And then the third thing that they missed was the effect of rising interest rates or the effect of record low interest rates on demand. I mean, that just spurred people that were on the fence, because what happens is people are weighing rent versus buy. You know, so at some point, young people, they just want an apartment, they don't have a family, that they're fine renting. But at some point, if you're renting for $1,500 a month and you can buy a $500,000 house for $1,500 a month, you're going to buy a house, whether you're ready for one or not. So that drove a lot of demand, because the rents became, you know, we're getting jacked up during the pandemic. The rents went up way higher than what your mortgage payments were. So now that conversation's flipped, where a lot of people that want to buy a house, that are living in an apartment or renting a house, they want to buy their own house. Now it's way more expensive, especially with insurance premiums going up, especially in coastal markets like Florida, mountainous areas where we had wildfires. Insurance premiums have doubled, tripled, quadrupled. Taxes are going up. So the cost of ownership of a house has gone through the roof. You did something the other day talking about the maintenance, the repairs, you know, all the carrying costs people don't think about, right? It's not the cost that kills you of the property. It's the maintenance, the repairs, and the carry that kills you down the road. So those are the things that the Fed just didn't take into consideration, that every average real estate investor knows, every average realtor out there knows. And we were all screaming from the rooftops, look, there is no inventory. This is an inventory problem, and it's a credit issue. That's what drives.
And also in terms of inventory, right? So if I have a house that I have a mortgage at 3.5%, there's no way in hell I'm selling that house, which gets rid of that mortgage. And then even if it's the same, let's just say I have a $200,000 mortgage left, I don't want to flip that mortgage into another house, because now all of a sudden the interest rate's up here.
Yeah, you're not going to sell that house. So every seller is a buyer. So there's two problems there. Number one, you've got that mortgage. Why on earth would you want to swap that for, you know, twice as much and pay record prices for houses? Doesn't make any sense, right? You're going to rent that out. You're going to keep it if you have to move. You might rent somewhere else. You're going to rent that out. The other thing is there's nothing to buy. So literally, you know, in your area, I'm going to ask you, if you want to buy a house right now and you're locked into a low interest rate, let's assume the interest rate didn't matter, that you could swap the same interest rate. What are you going to buy? There's nothing out there to buy, because not everybody wants a new home. There's a lot of new homes, and there's not new homes in every market. So again, real estate's hyperlocal. Some markets have more inventory than others, but most people out there that are locked into that low rate, rates don't matter when there's no inventory. This is an inventory problem. Again, we're 1 million plus units short of what is a normal inventory level in housing. And the other thing too is, so pre-pandemic, the average days on market typically in a normal housing market is about anywhere from 90 to 120 days. We've gone down to minutes. When houses hit the market, you're getting multiple offers in minutes and days. things like that. This is a very distorted, unusual, unhealthy housing market. The game has changed on an entire macro level. There's just with those interest rates as low as they went, with the availability, the funding is like it was. But the difference is this time, as opposed to 2008 and 9, is the borrowers are healthy, the loans are healthy, they put good down payments on, they've got record low interest rates. So it's a very healthy borrower.
Gotcha.
40% of the homes out there are owned free and clear. The other ones that have been financed, probably 60% of them to 80% of them are below 6%. Then there's probably 30 or 40 that are below 4%. There's about 20% that are below 3%. Some people have got sub 3% mortgages.
Amazing. All right. So having said that, guys, go follow Greg right here on Twitter. He's going to be, or he is joining the Verified Investing Network, and he's going to be launching probably in a month or so. We're going to be launching your 3-course real estate. Essentially everything.
Yeah, just like your courses.
Course,
yeah. So we've got a residential real estate investing course. We've got a commercial and multifamily real estate investing course, and then we've got a real estate development course. And then, of course, we're putting together a very special offer, a course bundle if you buy all 3. These courses are based. I also have a YouTube channel, by the way, thousands of videos sharing everything I know. So what I've done, I'm a serial entrepreneur. I've started 12 different companies, built them up and exited them. I've done hundreds of millions of dollars in real estate deals, starting with zero, no money, no credit. Nobody in my family were entrepreneurs. We were a working class, middle class family. My dad was military. I went in the military out of high school. I didn't go to college. What I did was educated myself, learned along the way. So I'm dumping everything I know, everything I've learned for the last 30 years, doing all kinds of real estate deals, building all kinds of companies, how to lead, delegate, motivate, how to build a business, how to do these deals, how to get out there, start your business, whether you want to replace your income, whether you want to build generational wealth, whatever it is. These courses are fantastic. Over 20 hours of content, all kinds of downloadable resources, interviews with the people that I'm coaching and mentoring all around the country in the different niches, what they're doing, how they got started, how they scaled their business. Man, these things are just unbelievable.
I'm excited to take it myself.
Yeah.
Thank you so much for coming on, guys. And again, one of the things I just want to say here is that verified investing is a lot of stocks, it's a lot of crypto, but you have to be the complete investor because you're going to have situations where crypto is quiet. Right now, there's not much going on there. You need, and I repeat, you need to know everything. If you want to be a multi-millionaire, maybe a billionaire, you've got to be ready to be able to invest in any sort of market out there, inclusive of real estate. Real estate is a huge, amazing market. So thank you, buddy.
One thing on that before I go. So you're absolutely right. So I invest in stocks and crypto as well. I went through Gareth's courses. They've helped me tremendously. I've doubled my account this year by what I've learned from him. Just amazing stuff. But here's the thing. So there were more millionaires created in real estate in the past than any other industry. Now there's more millionaires being created in the financial industry, in the tech industry. Real estate is now number 3, creating the most millionaires. But here's the thing. The most wealth is stored in real estate than any other asset class. Why?
Absolutely.
Because leverage, because tax advantages, and because real estate, you just can't duplicate it, right? It's not going anywhere. So if you're making money and you want to make money, you got to do something with it, and you want to diversify that for your generational wealth preservation. So that's what this is all about. It's a complete package. Make the money, store the money, make it here and there. You want to be a complete investor, a complete entrepreneur. That's what we're bringing you.
Wonderful, buddy. Thank you again.
Yep.
All right. We'll talk to you soon. All right, guys. So great information there, exciting stuff. I can't wait to learn more. Real estate is not one of my fortes, so I'm all about this course. All right, now we're going to get into it, guys. Look at this. Let's get right into some chart action here. So the first thing I'm seeing is that yesterday, very possibly, the yields may have had a short-term top. Here was a trend line, and look at what we hit yesterday. So again, the 10-year yield may have put in a short-term top right now. We'll have to see. But right now, I would actually think that you're due for a little bit of a pullback on the 10-year yield. Now, quickly going into this, right? So let's just erase those lines here. And let's go to a couple other charts that I have for you guys today. So one of the other things I wanted to show you guys, this is a tweet I put out yesterday, but I want to show you this. So my big concern is what we're seeing in semiconductors could be exactly what Bitcoin went through in 2021. Look at the pattern in Bitcoin. All right, so bear with me here. So look at this pattern here. Okay, and I'm not sure why it's not writing, but that's okay. There we go. So there we go. Look at this M pattern with a higher. So notice this high was higher on Bitcoin. And look at the downside that we saw. Now, if we go over here, you could argue that we're seeing the same sort of pattern formation in the semis. In fact, the semis have made a slightly higher high as well, and we're now coming off of those, all right? So again, the thought process here for me, I'm always looking for these avenues that give me an edge. I want an edge because that's how I make my money. That's how you're going to make your money. And really what we're seeing here again is the potential that you're at the beginning of this rollover period. Now, again, when we started to downtick, did anyone, aside from me and a few others, did anyone think this was going to happen? And the answer is absolutely not. That's exactly what we're going on right here. Right here, it's AI, NVIDIA. Oh my gosh, this is going to change a lot. Well, you know what? They said the same crap for the dot-com bubble. The same thing, and we know what happened there. Now, listen, it didn't mean that everything was wiped out. You could make a lot of money, but you had to be patient. Patient investing is so, so important here, guys. And again, I can't stress that enough. You've got to be ready to be patient and expect when everyone else is telling you AI is going to change the world. You can think it's going to change the world. I think it's going to change the world. But you know what? I also understand human psychology. And human psychology tells us that people get way too excited about it. Then there's this drawdown where people say, oh my goodness, this is going to take 5 years for this to really take hold, or whatever it is. They all panic and sell. Maybe it's because of a recession, which, by the way, is likely on tap for early next year. And ultimately, that's where you have a crash. Money runs for cover. Money here wasn't scared. Now it got scared down here. That's when it bottoms out. We're not scared in money on semis right now, or at least generally they aren't. So watch that very closely, guys. Here's another chart. Take a look at this. I tweeted this one out. Bear with me here as we bring it up. All right. In fact, I'm going to actually go to the actual, well, you know, we'll use this chart. This is Newmont Mining. All right. So I'm in a belief that gold is just about to start its next leg up and break out at the all-time highs. Newmont Mining to me is telling me that. Take a look at this, guys. You have this area right down here, right? So amazing right in this range. This is where we're just about, anywhere in this range. Look at the hit here on the trend line, the hit here, right here, the hit here, here, and here, right? All right, then also notice the double bottom. Notice both lines, and I hope you guys can see this. Both lines are converging at the same level. We're almost to that level. If we go to the gold chart here, let's go to the gold chart real quick, and we take a look at what gold is doing today. It's not doing a whole lot. It's basically flat. But to me, it's a breakout where it's consolidating. So we see here, this was your trend line breakout. We've gone up like this. Let me put this on the screen here. Let me erase my former lines. And basically, we've gone and we broke out from this high and this high over here. Okay? Now we've broken out to the upside. We hit the triple top. Triple tops, and this is important, guys. Triple tops give you small pullbacks versus double tops. This was a double top. It gave you a massive pullback. So triple top, small pullbacks, retrace to the scene of the crime, bounce, retrace, lull everyone to sleep. Everyone, again, markets do this at an expert level. They make you think it's boring. What's going on in crypto right now? It's boring. That's what markets do before they make a big move. As long as you're above this trend line here, which is around 1875, you should expect this type of explosive move. Triple top hit, which would then be a quad top, likely a breakout to the upside, all right? So again, guys, this is where it's at right now. I do want to go over something because I hear a lot of people talking about how yesterday I went into the Ethereum head and shoulders pattern, right? So we all remember the Ethereum head and shoulders pattern here. And if we look at that, bear with me as I go to this chart here. I want to make sure it's the same one. All right, so we talked about the head and shoulders on Ethereum, shoulder, head, shoulder, neckline. A lot of people are like, oh, there's a head and shoulders on Bitcoin as well. Wrong. All right, when you hear this, it's wrong. And I'm going to tell you why it's wrong. This is more education that, again, even good traders, they don't know this crap. And I'm going to make sure that when you guys tune into this game plan, I'm going to give you everything I know over the last 24 years now. I just calculated it out. I started trading in 1999, folks, just into that dot-com bubble. Whew, that was crazy. Just like many people, by the way, probably started trading in 2021 into the top on Bitcoin. That was me just in 1999. But the more important thing is, this is the problem. A head and shoulders has to be a human formation. Now, it can be a little lopsided, right? You can be a Quasimodo or something like that. That's fine. What you can't have is this high is lower than this, right? All right, that can't happen. All right, a head and shoulders, you cannot have a shoulder that is higher than the head. And in this case, this one's higher. Now, please understand, it doesn't negate the fact that this is an amazing trend line to watch. And if we break this trend line, honestly, we're heading to 25, then we're likely heading to 20, and maybe even back down here. It doesn't change the fact that that's a major trend line. But the reason why head and shoulder patterns are so freaking important is because you can calculate the target. If we go back to ETH, right? So if we go back to ETH here, and we go to this, all right, here's your ETH chart. The reason why this is such a good pattern formation is because you have the shoulder, the head, and notice again, the head is the highest point of either shoulders. Here's your neckline. It's that with head and shoulders, it allows you to calculate the target. All right, when it's just a regular trend line, you don't get that edge. And that's why head and shoulders are important. Now, again, there's so much misinformation out there. I want you guys to understand. Drop the plumb line from high there. When it breaks, wherever it breaks the trend line, you drop that same plumb line, and that gives you the target. All right, it's a measured move. From here to here should be here to here. That should be the target on a head and shoulders pattern. All right, I want to go over a couple other charts here as we go through. I don't have much time, but I appreciate you guys tuning in. I actually love you guys. Like, seriously, I look forward to these every morning now. I actually do. It's my point on time. All right, Target reported earnings. Let's take a look. Target, again, reporting earnings, guys. The stock here, this is the aftermarket or the pre-market. It is up on earnings. Now, again, if you look at their numbers, and this is a great example, their numbers stunk. They were not good. They were not good at all. But look at the daily chart. Look at this daily chart, guys. Look at the daily chart and look at where it's been, right? It's trading at the low end going back to like 2020. So what does that tell you versus an Apple that was trading at all-time highs going into earnings that beat earnings? It tells you that whatever analysts say, you don't necessarily pay attention to it. You have to look at the chart. Because in this case, they had some pretty horrendous numbers, but the stock was discounted so much that ultimately, guess what? The stock's up even on missed numbers, or not as good as Wall Street had anticipated. All right, another stock that reported earnings this morning is JD. JD here, let's take a look at the aftermarket on this. This stock is down. This is a Chinese kind of Alibaba / Amazon company. The stock's down a little bit, not that much. Yesterday we closed right around 36. It's trading at 35. I'm going to tell you this, guys. With the economic news, and I'm going to have to leave you on this, with the economic news on China, okay, that we got basically 24 hours ago or so, a little bit more than 24 hours ago, they're going to start printing. They have 20% plus youth unemployment. They're actually not going to even report on that number anymore. It's so bad. To me, they're going to print way more money than the Fed is ever going to print again, at least in the next 10 years. And that means that their economy is going to rev back up. They're actually in deflation. Deflation allows for unlimited printing. I mean, AKA, look at Japan over the last 40 years. They were able to do anything. Interest rates at zero forever until recently. So what this means to me, I'm starting to get interested on Chinese stocks as they come back in. So if we look at the daily chart on JD, for instance, you're basically back down to lows down here. And again, there's a double bottom down here, and it honestly could go a little bit lower. Don't think it can't go a little bit lower. I got some old trend lines here, not a big deal. But ultimately, I'm starting to get interested because my hypothesis is this, is that eventually we're going to get out of an arena where the U.S. is the prime place to put your money, and there's going to be China. And yes, China has a lot of problems right now. That's correct. But you know what? That's when you want to invest. When the more problems they have on an economic basis, the less they can crack down on their tech companies, which they were doing for the last couple of years and probably help screw themselves. All right. And they're going to be less likely to invade Taiwan, which again is a risk that you have to take when you're investing in China. So you have to understand the risks of that. The more economic issues they have, the less they're going to want to bring more economic issues that the world would place on them if they invaded Taiwan. So that gets pushed out. They're going to pump money into the system. And again, I'm not saying right now is the perfect opportunity, but if you have a longer term view on China, to me, it starts to make sense. Like even looking at Alibaba, starting to this is the weekly Alibaba, but look at this chart. I mean, these things are way, way down. And again, it does make me think there's a possibility here. All right, going back here, guys. Today, we've heard about some real estate information, some macro data on real estate, why the real estate market is doing what it's doing, how, in fact, you guys, if you're first-time home buyers can actually talk about getting a cheaper mortgage and then potentially refinancing in a few years. That's a very interesting aspect. I didn't even know about it. I'm not in the need of a mortgage right now, but I'm sure many of us are. Now, again, I want us to be clear. I am going to continue to bring everything I know to these game plans at 9 in the morning, every single morning, so that you guys go off into your day, whether you're trading, whether you're investing, doesn't matter. I want you to feel better informed, like you can make more money going forward. So thank you guys for tuning in. It's been another fantastic game plan. Follow Verified Investing on YouTube. Follow me on YouTube and on Twitter. I love you all. Thank you, and I'll see you tomorrow morning. Take care.